Good morning and welcome to our Responsible Investing Framework webinar. Thank you for taking the time out to join us today. My name is Kelly Castle and I work within the Institutional Business Development team. We know that ESG has been quite topical over the last few years. However, we thought we'd take the opportunity to not only share our views on the topic, but to showcase the work that Prescient Investment Management has put in to formulate a comprehensive and responsible investing approach to build a robust ESG integration framework. Presenting to you today will be Vanessa Mabophe, who is a quantitative analyst in our multi-asset team, and Jessica Phalafala, who is a quantitative analyst in our fixed income team, as well as chair of our ESG committee. If you have any questions throughout this webinar, please feel free to post them in the Q&A section and we'll address them at the end of the presentation. Please enjoy. Over to you, Vanessa.
Thank you, Kelly, and good morning, everyone. Thank you very much for joining us today. Okay. On the agenda today, we are going to start with an overview. At this point, we will be looking at the present investment philosophy, our ESG committee, and our overall approach to responsible investing. And then we'll dive a little bit deeper into responsible investing and then touch on the impact of COVID-19 on responsible investing. Then we'll take a closer look into impact investing. Once that is done, we'll move towards a due diligence approach where we are going to look at the UNPRI assessment and our in-house Prescient ESG scoring methodology. Lastly, we will take a look at the 2021 ESG themes. So how do we differentiate ourselves from our competitors? Well, that is simple. We are a systematic investor. This means that our daily processes are based on a quantitative approach that heavily relies on data. In fact, on any given day, we process millions of data points, therefore ensuring that we're able to generate core signals for each asset class and thereby eliminating human bias, since our processes are already properly tested and are very robust. Generally, we are in the business for the long run. This means that sustainability is one of our core objectives. Furthermore, risk management is a bedrock of all our decisions. It is for these reasons that we pride ourselves as being able to achieve persistent long-term returns on a risk-adjusted basis. When it comes to responsible investing, we employ a holistic and integrative approach. This approach is taken at 3 levels. From the first level, this level is the corporate level. It mostly has to do with the people factor. And examples of what we would be doing at this level would be the fact that we are a level 1 BE contributor. The company continuously empowers its employees through various training programs and ongoing learning. And from a broader community perspective, we have the graduate program, and also there are various other projects that we take part in via the Prescient Foundation. Lastly, we are signatories of the UNPRI and we abide by the codes of CRISA. From the second level, this level is the product development level, and it is at this level that we're able to create ESG-centric products. And this is the leg where, for instance, we'd be able to actively take part in impact investing. And in fact, we do have a fund that is tasked to assist us with achieving that goal, and that fund is the Prescient Clean Energy and Infrastructure Debt Fund. Lastly, at the last level, we have the investment process. This level has to do with our day-to-day activities as a business. So this would include idea generation, security selection, and overall portfolio construction. So now that you understand our overall approach to responsible investing, your next question might be, who is tasked with ensuring that these goals are in fact met? Well, we do not have a designated person, but we have an entire committee. And what is very interesting about this committee is that not only does it include key strategy drivers of the business, but it is also represented by all the asset classes. So from a key strategy driving perspective, we have our CEO, Cherie, and our CIO, Bastian. Then we have Conway, who is the head of credit, and he represents the credit team. CISO represents the equities team. Jessica represents the fixed income team, and she's also the chair of the ESG committee. Lastly, I represent the multi-asset team. Our objectives and responsibilities are quite clear. We are tasked with supporting the company's ongoing commitment to ESG investing. In doing so, we set and drive the ESG strategy. We oversee ongoing ESG-related communication, and because we are big believers in order for us to be able to stay ahead of the curve when it comes to ESG integration, we have to invest in quality research. It is for this reason that the last responsibility is monitoring developments. Now that I've briefly touched at our overall ESG approach, I'm going to take you through the overall history of responsible investing. Responsible investing itself dates back from the 1700s. However, there has been so much that has happened over the years that we have to classify it in different eras. So I'll first start with the first era. This era is the socially responsible investing era, and it mainly has to do with negative screening. So at inception, it was mostly faith-based negative screening. So for instance, you would find an investor who, based on faith principles, would not invest in companies or any organizations that are associated with industries that are such as in the alcohol business or tobacco business. But as time moved on, the scope itself broadened, and it did not just include faith-based principles, but it also included socially based principles. And one good example would be in the 1970s and 1980s, where socially motivated investors shunned apartheid South Africa. Since then, there's been further more evolvements to a point where the era itself changed to what we now know as ESG, which is environmental, social, and governance investing. This era started informally in around 2004 when the former UN General Secretary Annan sent letters to over 50 CEOs of major companies, asking them to take part on a joint venture where they would integrate ESG principles in capital markets. By 2005, ESG was more formalized, and we saw that by 2006, the UNPRI was launched. And as time moved on, we saw that impact investing came about in 2007, and by 2020, impact investing based products or investments were estimated to reach $715 billion in AUM. This estimation was given by the Global Impact Investing Network. And by 2021, this number is expected to reach $1 trillion. We are all aware of the effects of COVID-19 on financial markets. However, financial markets were not the only aspect that was affected. In fact, from an SDG perspective, all sustainable development goals were affected. For some of you who may not know what the sustainable development goals are, these are the goals to end poverty, protect the planet, and ensure that all people enjoy peace and prosperity by 2030. And these were adopted by all UN member states in 2015. So now the question that may arise would be, how were these SDGs affected? So the SDGs were affected in two ways. Some of the SDGs were explicitly affected and the others were implicitly affected. Those which were explicitly affected are the SDGs that were directly affected by the effects of COVID-19. So those would be, your no poverty, zero hunger, good health and well-being, just to name a few. And just to bring it a little bit more into context, we could see the effects when the global lockdown started. So everyone who was able to make a smooth transition to a work from home environment was relatively able to keep their standard of living intact. However, there are some of those who lost their income entirely. And a good example of such people would be, for instance, a lady who sells fruit by the taxi rank. Of course, from an inequality perspective, such a person would be driven to the poverty line, and these inequalities would be widening. So in a nutshell, these directly affected goals really shine light to the social aspect of ESG. On the other hand, the goals which were implicitly affected were affected in the sense that because focus had to shift towards the directly affected goals, these goals were neglected. And in fact, there is a potential that there is a regression in the progress that was already made towards succeeding in these goals. Now that we've seen how COVID-19 affected the various SDGs, the next question was, how can then impact investing play its role in bringing back the damage, or in lessening the damage that was caused by COVID-19 on these various SDGs? And in answering this question, I'll just first start by explaining what impact investing is, and then dig a little bit deeper into what constitutes impact investing and the vehicles therefore. So impact investing is pretty simple. Imagine an investor who is financially conscious, but also this investor has a consciousness of the environment or other factors such as social or governance. So ideally, this investor would be happy if they are able to see an overall progression in both of these goals. So impact investing products would be able to marry the two goals of such an investor, therefore ensuring that over the long term, this investor is able to not just attain financial growth, but is also able to attain overall improvement in the surroundings or the environment. And the factors that, or the characteristics of impact investing that one should understand are: number one, impact investments need to be measurable. So the impact aspect of impact investment needs to be properly measurable. So from a financial perspective, that is quite simple. But when it comes to the overall impact, let's say from an environmental perspective, then we'll be looking at things such as how much clean energy was produced by that project. And then lastly, such impact has to be positive. So then now the next question you might have is, why does it matter? Why does impact investing matter? And just to answer this question, I'll focus more on the environmental aspect, or on the environmental pillar. So assuming that we continue being naive with the current damage we're doing to the world and the effects of global warming, we are bound to reach a point where we have driven the earth to a point where it can no longer sustain us. At that point, we will be forced to reinvent the wheel, and in fact, even be forced to create our own oxygen supplies. To me, that is just wrong, and it is definitely not sustainable. So now, what can you and I do to ensure that such an error does not materialize? Luckily, there are already strategies in place that look at, number one, mitigating such effects. So in this case, we'd be looking at things such as reducing or removing greenhouse gases from the atmosphere. And number two, once we've mitigated such effects, we'll be looking at the adaptation aspect. This would entail adjusting our overall society and existing systems to withstand the effect of climate change. Lastly, this will also present some opportunities, and these opportunities would be in the form of impact investing vehicles that would be looking at directly tackling such environmentally based or any other ESG aspect that the person might be interested in tackling. Now, as a company, how do we play our role? Because we already understand that impact investing is important, and it is also important that that we are able to measure it. So as a company, we play our part in the product development level. And as mentioned before, this is the level where we are able to create ESG-centric products. Another thing I highlighted before was that the overall impact itself needs to be measurable. Of course, the financial aspect is very easy to measure. However, the overall impact on the surroundings itself tends to be a bit trickier. So as a company, we saw it as very prudent if we benchmark ourselves against the UN's SDGs. And we're very proud to say that our current projects are currently tackling 6 SDGs, and these SDGs include affordable and clean energy, reduced inequality, and climate change, just to name a few. The Prescient Renewable Energy Fund is the fund that allows us to play an active role in this space. And this fund has a very straightforward strategy. The strategy is to provide debt financing to clean energy and infrastructure projects in South Africa. And also, its outcomes are straightforward too. These include reducing carbon emissions, creating jobs, providing socio-economic and enterprise development, and lastly, delivering infrastructure needed to facilitate growth. Furthermore, this project allows us to be active drivers of the social and environmental change agenda, and we are therefore able to play direct participation in the Renewable Energy Independent Power Producer Procurement Program. On the right-hand side, you will see a map. That map details 17 active projects that the fund is currently invested in. And as you can see, these projects are scattered across the country. But just to get an idea of what type of projects we would deem as worthy to include in the project, I will take you through 2 projects, which are the Loris Fontaine project and the Cobab project. Both of these projects are located in the Northern Cape, and the Northern Cape is known for being the biggest clean energy producer. And these projects specialize in onshore wind power. From a size perspective, each project produces 135 megawatts. And again, shining a bit more light into the measurability of the impact of the project. Here we look at 3 things. The first aspect is the electricity production, and you can see that approximately 560,000 megawatts are produced annually by each project. And the second aspect would be the number of homes powered, and we can see here that 65,000 homes are powered per project. And lastly would be the labor aspect, and this aspect would be the one directly dealing with alleviating poverty and no hunger. And we can see here that 2 million man-hours of construction activity went into the joint production of these projects. Lastly, especially from an investment perspective, credit risk becomes a concern. And it is quite warming to know that the power purchaser of the power produced by these projects is a 20-year government-supported PPA with Eskom. This therefore means that credit risk is limited, if not at all eliminated. Now, another concern when it comes to impact investing projects is there seems to be confusion whether impact investing adversely affects performance. And as a house, we can proudly say that that should not be the case. And in fact, when we're looking at the performance of our Prescient Clean Energy Debt Fund, we can see that over 1 year, 3 years, 5 years, and since inception basis, the fund has outperformed its benchmark by a great margin. But it's not just the financial aspect that benefits the investor. There are other benefits that one would stand to gain from investing in such a product. So these benefits include overall portfolio diversification, predictable cash flows, less return volatility, low default risk, which speaks to the credit aspect, and lastly, higher risk-adjusted returns, especially where investment is made early in the project. Now that you know how we play our part in the impact investing space, I will hand over to Jessica, who is going to take you through the second part of our presentation. Thank you very much.
Okay, thank you very much, Vanessa and Kelly, and I'd like to thank everybody for your time this morning. This, as Vanessa mentioned, brings us to the second part of our presentation. I will be discussing the additional legs of our responsible investing approach. I'll begin with discussing the corporate leg, and I'll be focusing particularly on our UNPRI assessment score. For those who are not familiar with the organization, the United Nations Principles for Responsible Investment is the world's leading proponent of responsible investment. The organization works to understand the investment implications of incorporating environmental, social, and governance factors, and it also works to support its international network of signatories in incorporating ESG factors into their investment and ownership decisions. Prescient has been a signatory of the United Nations Principles for Responsible Investment since 2007, and we have since undertaken the task to participate in their annual assessment in order to benchmark ourselves against the global standard in responsible investing. This particular slide is looking at our 2019 assessment scorecard. So in 2019, we were assessed across 4 modules, namely strategy and governance, listed equity incorporation, listed equity active ownership, and fixed income corporate financials. The median scores for each category are above and our corresponding assessment score below. And as can be seen, we unfortunately scored below the median score across all 4 modules. However, we did not let that discourage us. In fact, in 2019, we formally appointed the Prescient ESG Committee, and one of the initial tasks of the committee was to develop a suite of responsible investing policies that include our ESG policy, engagement policy, as well as our proxy voting policies. In addition to this, we have developed a tool that allows us to evaluate the ESG performance of the different companies within our investment universe. And finally, we have increased our engagements with our investee companies. And in addition to this, we actually engage with public policymakers in order to foster the uptake of responsible investing in South Africa. This has resulted in a significant improvement in our 2020 assessment scorecard. Here we were evaluated over 5 modules: strategy and governance, listed equity active ownership, and 3 fixed income categories. And the median score for 2020 is above and our current corresponding scores once again below. And as you can see, we have had a significant improvement across the board, which we deem to be a story of success. In particular, I would like to highlight that for strategy and governance, we have scored the maximum score of an A+, and we deem this to be quite a significant achievement. This brings me to our ESG integration process. This is concerned with the 3rd leg of our responsible investing approach, and that leg is the investment process. Here we are concerned with the deliberate and systematic integration of environmental, social, and governance factors into our idea generation, security selection, portfolio construction, and proxy voting processes. The cornerstone of our ESG integration process is the Prescient ESG Scorecard, and it has been developed with 3 objectives in mind. The first objective is that this tool would be a systematic due diligence process that would allow us to analyze the ESG risks and opportunities that are associated with the equity and credit counterparties in which we invest. The tool is also data-driven and free from human bias, which dovetails well with our overall investment approach. The second objective of the scorecard is that it would be evidence-based, and we have done so by designing it using measures that have been empirically proven to be good indicators of the ESG practices of different companies. And finally, and probably most importantly, we ensured that our ESG integration process is included to our existing investment process as an enhancement or an overlay. So this ensured that our existing process is not compromised in any manner. So in terms of the properties of the scorecard has 60 plus underlying metrics. So we have 60 metrics that we collect from the integrated reports of the companies within our assessment. The scorecard is free from market size biases. And what we mean by that is that we take into account the market size of the different companies within our assessment. So we strip the numbers of the company size component, and then that ensures that we are able to compare like for like, and that we don't disadvantage or advantage certain companies due to their company size. The third property is that the scorecard provides us with multi-tiered granularity. So by that, we mean that we are able to gain insights on the ESG performance of the entire investment universe, the different sectors within that universe, and finally, we get insights into the ESG performance of each company within our analysis. And finally, the scorecard updates automatically, and this allows us to stay abreast with industry developments. So in terms of the architecture of the Prescient Scorecard, it is driven by the trifecta of sustainable finance. That would be environmental, social, and governance factors. For the environmental pillar, we are concerned with the direct environmental impact of each company and its contribution to the climate change mitigation. For the social pillar, we are placing more emphasis on how the company treats its employees and the broader community. And finally, for the governance pillar, we are looking at the structure, the ethics, and the activities of the company's boards. So these are the pillars that make up the ESG scorecard. For each company within our analysis, we assign a separate environmental, social, and governance score, and then we quantitatively aggregate those scores in order to provide us with an ESG score out of 1. To provide you with a better understanding of some of the metrics we consider and the themes we also look into, I will dive into each pillar briefly. For the environmental pillar, we consider 5 themes, namely emissions, energy consumption, water usage, waste management, and policies and disclosures. For the first 4 themes, we are concerned with the direct environmental impact of the companies in question. And for policies and disclosures, we are trying to get a sense of whether the company in question has clear environmental targets and if it has put policies in place in order to assist it in meeting those goals. For the social pillar, we consider 3 themes, namely employee diversity and investment, safety of the employees, and policies. And once again, we are trying to get a sense of whether the company in question is committed to creating a safe, equitable, and harmonious environment for its employees. And finally, for the governance pillar, we consider 6 broad themes, namely board structure, board responsiveness, and then we also look at the structure, the responsiveness, and the independence of the subcommittees of the board. And then finally, we look at diversity. So here we are trying to identify whether there's some underlying risks within the company's board. So to put all these ideas together, we can summarize the scorecard process as follows. Firstly, we receive thousands of data points from the integrated reports of the companies within our analysis. We then use those data points as inputs into our scoring methodology. And I'd like to stop here and just emphasize that the scoring methodology is our proprietary, and we have full oversight over the methodology that's used. The output of the scoring methodology then provides us with insights into the performance of the investment universe, provides us with the ESG performance of the different sectors, and finally, the individual company ESG scores. All this data is then made available in our in-house interactive dashboard, which our entire investment team has access to. And there they're able to navigate within the universe, the different sectors, and the different companies in order to aid them through their decision-making process. To give you a sense of how these results look like, I'll first touch on the universe-wide results. So the diagram on the right shows you the different constituents within our investment universe. Each data point represents a particular company, and the smaller the data point and the darker the data point, the lower the ESG score of that particular company. The larger the data point and the more yellow the point, the higher the ESG score of that particular company. So that gives us a sense of who are the ESG laggards and leaders within our investment universe. Although the different companies are scored within their sectors, we do take into account the materiality of the different metrics and as well as the materiality of the pillars within each sector. So you are able to still assess these companies as an entire universe due to the fact that we have removed materiality biases. Another highlight of the scorecard is that we are able to track the ESG performance of the universe through time. So we are able to track this performance from 2008 to today. And this provides us with a quantitative measure of the uptake of ESG in South Africa. It also provides us with some insights into some of the structural properties of ESG in South Africa. So, for example, if one was to look at governance and its evolution through time, you would notice that governance has been rather stable through time, and that's due to the fact that many of the companies within our analysis adhere to the King reporting standards. Similarly, the social score for the entire universe has also remained rather consistent through the decade of our analysis. And that's mainly due to the strong trade union presence in South Africa. And finally, the environmental score has been rather volatile compared to apologies for that. So, and then the environmental score has been quite volatile compared to the governance and social scores. This is due to the fact that there's limited environmental reporting standards in South Africa, except for, of course, the highly regulated basic materials sector. And then we get insights into the sector-specific performances. This can be seen in the chart on the right. Here we are representing the banking sector and all of its constituents, and we are able to track how all the constituents have performed through time. And the lighter and the more orange the block for each year, the lower the ESG score for that constituent, and the more green the area, the higher the ESG score. So this allows us to identify the risky sectors and to also identify sectors where there are some ESG related opportunities. Finally, the scorecard provides us with those company-specific performances. And in this particular slide, we've included a screenshot of the dashboard that is used internally. So our investment team is able to navigate between the different sectors and then select a particular company within that sector. And this is the dashboard that they are able to view. For each company, they are able to see the current ESG score. So for example, this particular company has an ESG score of 0.8 out of 1. They're then able to see how each pillar has contributed to that overall score, and then track the historical performance of that company through time compared to its sector average, so you can get a sense of whether that company has underperformed or outperformed its corresponding sector. And finally, you're able to receive descriptive statistics on that company's ESG performance. It doesn't end there. In fact, the ESG scorecard also allows us to get a sense of the exact metrics that have contributed or detracted from the ESG performance of that company. So the question remains, do ESG practices impact company returns? And we have run a number of backtests upon completion of our scorecard. One of the results are here in the slide. What we have done is we have looked at how different companies scored have either improved or deteriorated year on year. The top 20 companies in terms of their improvement of their ESG score year on year were placed in one particular portfolio, and then the bottom 20 companies in terms of the deterioration of their ESG scores year on year were placed in a separate portfolio. These portfolios were recalibrated at each point in time where the ESG score is updated. And as can be seen, the top 20 portfolio has outperformed the bottom 20 portfolio quite significantly. In fact, post the COVID-19 crisis, the top 20 bucket gave us quite a strong recovery. So it's quite visible to see that top performers from an ESG perspective provide us with long-term sustainable returns in line with our business objective. And one last question you might have is, how is this implemented in our investment process? So the Prescient credit rating framework has historically consisted of 3 quantitative models, namely the Altman-Z model, the Merton KMV model, and the credit scoring model. We have now added a 4th dimension to this credit rating framework, which is the ESG score, and we use the ESG score in a notching process. So issuers are assigned an ESG score, and then they are divided into quintiles depending on the score that they've received. The underperformers, so those in the 1st and 2nd quintile, receive a 1 or 2 notch downgrade to their credit score. The average ESG performers receive no change to their credit score. And finally, those who have outperformed from an ESG perspective receive a 1 or 2 notch upliftment in their credit score based on the degree of their outperformance. This then helps us decide on which counters we are credit positive or credit negative. However, this is not limited to our credit process. For those familiar with our equity process at Prescient, it is largely underpinned by the core equity strategy. The core equity strategy is a portable alpha strategy where we receive our effective exposure through derivatives. And then what we have done is we have implemented the ESG scoring methodology on the cover assets which we hold in those funds. This brings me to the end of the Prescient ESG Scorecard. However, we felt that it would be important to end this presentation on a lighter, less technical note by discussing some of the ESG themes that we feel will be prominent in 2021. We have identified 3 themes, namely vaccine inequality, digital ethics and privacy, as well as climate change. To dive right into vaccine inequality, the first topic that comes to mind is that of vaccine hoarding. Many developed markets have secured pipelines for more doses than their populations. A case in point would be the fact that the United Kingdom initially acquired 367 million doses, which is 5 times more than its population of 67 million. On the other hand, emerging markets have acquired far less than is required to vaccinate their citizens to herd immunity. The second topic within vaccine inequality would be that of the vaccine premium. Here, low-income countries are most vulnerable due to the fact that the supplies of the vaccines lies largely with developed markets. As an example of this, South Africa procured 1 million doses of the AstraZeneca vaccine in early February. The million doses arrived at a cost of $5.25 a dose, which is more than double the $2.16 that European Union countries paid to AstraZeneca. This is a significant premium to pay, and it limits the post-vaccine trial access that emerging markets could have had. Finally, we see the developed markets recovering far more stronger than their emerging market counterparties. And this is due to the fact that developed markets have administered vaccines at a significantly faster rate, and thus largely eliminating any ESG related risks. So, and we've already seen some developments of this nature, we will see a flight or a renewed flight to safety into the developed markets. So it's very clear that the issue of vaccine equity is the biggest question that lies before the global community. A second theme that we are looking at for 2021 is that of privacy. In fact, digital privacy as well as ethics. And this is due to the fact that it is deemed as a basic human right and speaks to the social aspect of ESG. The reason why this theme has become quite relevant is that on the onset of COVID-19, we saw millions of workers working from home and pupils learning from home. And this resulted in an increased reliance on technology while we had little to no digital privacy literacy. As such, this made the global community more susceptible to data breaches, like we saw in the data breach of April 2020, where 500,000 passwords were stolen from Zoom. So this has turned the attention on consent structures such as privacy policies. However, as many of you know, these privacy policies that many applications have are rather long, and the trend that we have seen is that consumers have resorted to not reading these terms and conditions and agreeing to them without having perused through them. Then they later find out that their location, spending habits, and search data is being collected unbeknown to them. However, there have been green shoots in this particular area. And these green shoots are in the form of the ongoing antitrust lawsuits in the United States that are trying to rein in anti-competitive behavior in the big tech companies. This introduction of competition within the tech space will allow for the industry to be better regulated and give consumers the option to choose between service providers based on their privacy needs. And finally, we see 2021 as being the year where we will refine climate change mitigation. We saw over the course of 2020 unprecedented fires across Australia and the United States, flooding in France and Italy, as well as the relentless droughts in South Africa. And this brought the issue of climate change to the forefront and really highlighted its urgency. One of the topics that have come to the fore would be the topic of eliminating greenwashing. For those who are not familiar with the term, greenwashing refers to companies that spend more time and money marketing themselves as environmentally friendly instead of committing to actually minimizing their environmental impact. However, there have been some green shoots in this area, and one of them would be the European Union's sustainability taxonomy framework, which has been developed in order to assist us in, or assist the European Union in classifying economic activity as environmentally sustainable. South Africa is also not too far behind, as we are also in the process of developing our very own South African green finance taxonomy. A second topic in this area is that of the working from home age. With the onset of COVID-19, we quickly saw a lot of the world working from home, and we saw that the impact of commuting workforce on the environment is significantly large. We saw the biodiversity recovering across the world and air and water pollution decreasing significantly across major cities. In response to this, many companies across the world have decided to implement their working from home policies on a more permanent basis. And then the final and probably the highlight event from a climate change perspective this year would be Glasgow 2021, that's taking place in November of this year. Here, global leaders will come together in the successor to the landmark Paris meeting of 2015. We suspect that global leaders will commit to further cutting on their carbon emissions, and this particular meeting would be quite interesting due to the fact that the United States has rejoined the carbon cutting chorus post the election of President Biden. This brings me to the end of our presentation. However, I would like to leave you with 3 key takeaways. The first being that impact investing will play a pivotal role in the post-pandemic recovery. The second being that quantifying ESG risks can unlock an additional source of excess returns. In fact, we believe that quantifying these risks allows us to maintain our high standards as investment managers while tackling sustainability. And finally, ESG issues will continue to gain traction going into 2021. I'd like to thank you very much for attending our presentation. However, I will hand back to Kelly should there be any questions from the audience. Thank you, Kelly.
Thank you, Jessica and Vanessa. While we have you at the podium, there are a few questions that have come through. So for you, Jessica, there's a question on TCFD. So that's in terms of the climate risk disclosures. Where do we stand in terms of disclosure of ESG risks?
In terms of the TCFD, we follow the guidelines of the UNPRI, and we are in the process of integrating this within our ESG scorecard.
Thank you. And then what sets Prescient Investment Management's ESG process apart from its peers?
I think what sets us apart from our peers, and it's very clear in our presentation, is that we are not using external third-party scores in order to evaluate the companies within our investment universe. What we have done is we have stuck to our signature of having a systematic way in which we evaluate different companies, and we have built the scorecard using our own methodology, using our own research, and also our own scoring techniques in order to allow us to know exactly what has gone into the scoring methodology and to implement it with the confidence that one wouldn't have using a third-party service provider's ESG scores.
And then just 2 more questions for you, Jessica, is how do you take into account materiality within the scorecard? And does the scorecard cover only local companies or issuers? Does the scorecard only cover local companies and issuers?
Okay, so currently the scorecard does only cover local companies and issuers. However, one of the tasks for this year is for us to expand the coverage of the scorecard to global constituents, as well as to move into the unlisted space with the help of our credit team. And then in terms of materiality in the ESG scorecard, what we do is we've assigned different weights to the different themes within each one of the pillars, and then we've also assigned sector-specific weights for each one of the pillars. So a particular weight for environmental, social, and governance for each of the different sectors. As an example, the basic materials sector has a far larger weighting to the environmental pillar than the remaining sectors.
Thank you, Jessica. I just have 2 questions for Vanessa, please.
Okay, thank you very much. I'll hand over to Vanessa.
Thanks, Jessica.
So Vanessa, from an impact perspective, are you looking to broaden your reach as a company?
Thanks, Kelly. So yes, there is continuous research being done in-house by the various teams to see where can we play our part. But I mean, even with the already existing fund that is already ESG centric, there is also ongoing research in that aspect. So yes, we are always looking to grow, but we just want to ensure that before we launch anything, we do have the proper research that backs the strategy up.
Okay, and just in terms of your Prescient Foundation, our Prescient Foundation, could you please elaborate on some of the projects?
So there are various projects that the foundation takes part in. So for instance, one of the initiatives is the scholarship program, where it looks at deserving learners in primary and high school, and then offer scholarships to them. But then on a more frequent ongoing basis, there are various leadership summits, and these leadership summits would look into grade 7 learners, and there would be a series of topics that are discussed. And on a more social aspect and broader aspect, there would be specific projects, like for instance, when it's Women's Month, there would be a Women's Month specific project. So where, for instance, the organization would run a fundraising to help an organization, like for instance, St. Anne's, with providing diapers and any other things that mothers who find themselves in difficult situations would be finding themselves needing. Thanks.
Thank you, Vanessa. There are quite a few questions coming through. Just if we don't get to everybody, I have published on the Q&A an email address that you can send through any questions relating to responsible investing at Prescient, or if you have any interest in the Prescient Clean Energy and Infrastructure Debt Fund and would like some more information, you can reach out to your respective business development manager, or you can email us directly. I do have 2 more questions, but I think it's more for Jessica that has come through. So thanks, Vanessa.
Thanks, Kelly.
Okay, so how can your in-house scoring enable fair comparison when there is no South African standard for reporting and disclosing ESG risk factors?
Okay, I think it does still allow for fair scoring due to the fact that we are using metrics that, as I mentioned, have been empirically proven to indicate the ESG practices of companies. So we haven't, just come up with the scorecard without doing the relevant research. We have done the research and also collaborated with certain service providers in order to allow us to make sure that we are considering the correct metrics that can provide us and with a better insight into the ESG risks and opportunities that lie with the companies that we consider.
Okay, and then has Prescient made a commitment to the implementation of net zero portfolios? In your view, can net zero portfolios be implemented in South securities?
Sorry, I didn't catch the last part of that question.
In your view, can net zero portfolios be implemented in South securities?
Okay, so we have not made a commitment to net zero portfolios. However, I think this is something that we would probably be very ready to commit to within the coming year.
Great. Thank you very much. And thank you once again to everybody for joining our webinar. As I said, if you have any further questions, please feel free to reach out. But other than that, have an amazing day further and please stay safe.
Thank you, everybody. Cheers.